Hello friends, good evening to all of you. Welcome to the CMA Final Advanced Financial Management Comprehensive Revision Series. I'll briefly introduce you to this revision batch, what are the aspects of this, and then we'll start discussing the basic concept, that is time value of money in this segment. See, this batch will run for approximately 40 hours, plus or minus 2 or 3 hours, but more or less 40 hours is the planned time for this batch. And in this batch 80% of the syllabus will get covered, most of it, okay, because the balance 20% out of the 20%, 15% of that will be of theory topics, and mostly more than 90% of the practical concepts will be covered in this segment itself, right? And then in-depth concept will be discussed. More priority will be given to concept rather than question answers. So question answers will also be discussed, and only concept clarifying questions will be discussed as such, not all the questions, because if you see for same concept there are so many questions available, repetitive questions will be there. I will not be discussing all those questions, only concept clarifying core questions, okay, will be discussed, right? So more priority will be given to the concepts as such. We will take more time for concepts, and we'll discuss questions also, comprehensive questions we will discuss. So this is the plan for this batch, right? So let's get started. We'll move on to the first area, that is time value of money. See, what is time value of money? Very simple. Today's money is more valuable than tomorrow's money. Why is it so? Because of two reasons. One is inflation, other is risk. Very simple, yeah? For example, today 1 kg of rice is costing 60 rupees. Assume it is 60 rupees. Please tell me, after 10 years, whether you can buy the same 1 kg of rice using this 60 rupees? Not at all possible. Why? Because of the diminishing purchasing power of the money. Are you understanding? So this 60 rupees value will get diminished over a period of time. Okay, so next year's value of the same 60 rupees will be less, because you only can buy less number of less quantity of whatever items you are purchasing. Okay, because the value of the money has been diminished. This is called as inflation. So due to inflation also, the value of money is getting reduced. Next reason is risk. Why? What is risk actually? Risk is nothing but risk arises from the uncertainty of the cash flow. Very simple, yeah? So for example, today you are depositing 1 lakh rupees in the bank, okay? Whether or you are lending, say you are lending your friend 1 lakh rupees money, correct? So in that case, whether you are confident that next year he will pay you back this 1 lakh for sure, 100%, not possible, correct? You will not be 100% sure that this amount will get repaid back, correct? There will be some default risk. Are you understanding why this is arises now? Because today is certain, tomorrow is uncertain. Because of uncertainty, there will be some risk also now. So for compensating the risk also, you need to pay some compensation. Due to these two factors, today's money is more valuable. Due to these two factors, inflation and risk, tomorrow's money will be less valuable and today's money will be more valuable. The difference between the value of money tomorrow and today, okay, is known as time value of money. Very simple. Assume you are going to a bank and depositing 1 lakh rupees. You are going to a bank and depositing 1 lakh rupees. Now, the bank will pay, assume at 10%, it will pay interest at 10% for 1 year deposit. Say 10,000 will be the interest, correct? The maturity value of your principal portion, okay, along with the interest, which will be 1,10,000, correct? So the bank will pay your principal as well as the interest of 10,000 rupees. Why this is happening? Why bank is paying interest, correct? Why it is paying 10,000 rupees is interest? Now that interest is a compensation for these two things which we discussed. One is this interest will have compensation for inflation. Because of inflation also, your money 1 lakh rupees you are deposited today now. Since today's money is more valuable, okay, next year due to inflation you cannot buy the same amount of thing using 1 lakh. So your money value is getting diminished. So you need compensation now. The bank will pay you compensation, right? Not only that, also it needs to pay compensation for risk also, correct? So for that reason also it will pay interest. So this 10,000 interest has two components. One is inflation and other compensation for two things. Compensation for two things. One is for inflation, other is for risk undertaken. Are you understanding? So interest rate, what do you mean by interest rate? Is interest rate as a whole has two components. One is compensation for inflation rate, that is inflation in the country. Next is risk premium. Okay, say interest rate is 10%, now it will have two components inherently in it. One is inflation rate compensation, compensation for inflation, as well as the compensation for risk. See, if inflation rate of this country is 6%, which means the balance portion is a risk premium. Now you cannot say it's exactly 6 and 4, why I'll tell you later, international financial management, we are going to study international Fisher effect and all, money rate, inflation and risk premium, we will combine it all there. Just understand the fact that interest rate, okay, interest which you are receiving from the bank or which you need to pay, correct? For borrowings, you need to pay, correct, interest, and for deposit, you will receive interest. Either case, the interest which you are paying or receiving will have compensation for two things, inflation, other is risk. Okay, next, see, very simple. Is it right? See here. So what cannot be done now? You cannot simply, this year 1, 2, 3 cash flows are given, 1 lakh rupees, 4 lakh rupees and 3 lakh rupees. At the end of year 1, you will receive 1 lakh, end of year 2, you are going to receive 4 lakh, end of year 3, you are receiving 3 lakhs. Total is 8 lakh. Am I correct or not? No. Time value of money, okay, won't permit us to add simply the cash flows of different time periods, correct? So what you have to do, you have two options. Either you need to discount and bring the future money in present value terms, or you need to, okay, see here, very simple, yeah, in the second year cash flow of 4 lakh rupees, you bring it to year 0. Okay, year 1 end, the cash flow is 1 lakh now, you bring it to year 0. Then year 2, end of year 2, you are receiving 4 lakh now, that also you bring it to year 0. Then 3 lakh rupees which you are going to receive at the end of year 3, that also you bring it to year 0. And you can total, you will get present value of all these cash flows. Either that you can do, or what you can do is that you can take all these cash flows to a future date, which means end of the year 1 you are receiving 1 lakh rupees, end of year 2 you are receiving 4 lakh rupees, and end of year 3 you are receiving 3 lakh now. At the end of the third year, you take all the first year, second year and cash flows to third year, and you will get a future value. So see, very simple. When you bring the future year's cash flows to year 0 terms, today's terms or present value terms, it is called as discounting. And if you take, okay, today's cash flows or year 1 to 3's cash flows to third year terms, it is called as compounding. Very simple, yeah. Discounting is nothing but taking out of interest. I told you, see, today's money is more valuable now, the principal portion which is getting added by the interest portion. So if you take out the interest, you will effectively discounting. Discounting is nothing but take out the interest portion from the maturity value and getting the real interest principal portion, correct? What is compounding? Compounding is nothing but adding the interest portion or compounding the interest portion with the principal portion, correct? So all this I have explained here. Briefly, I explained. So yeah, next, moving on quickly. See, 4 different cash flow streams are available. One is single cash flow and annuity cash flow, perpetuity cash flow and multiple uneven cash flow. Take single cash flow for example. What do you mean by single cash flow? Very simple. The cash flow occurs only once. For example, after 3 years, you are going to receive 1 lakh rupees as cash flow. And it is a one-time event. Once you are going to receive this 1 lakh rupees, but only at the end of year 3. This is called as single cash flow. Okay. How to discount and find present value, we will all find it out. Okay, we will discuss elaborately. I'm just explaining what are the different types of cash flows available. Are you listening? First, we are trying to understand what are the different cash flows. Next, to come to annuity cash flow. See, annuity cash flow, same cash flow will occur for n number of years or n number of period. Very simple. Year 1 to 3, if you are going to receive or pay, assume 1 lakh rupees, which means every year. See, in our subject, wherever specifically does not mention that you are going to receive at the beginning of the year, we assume generally year 1 to 3 na, what we generally assume is that at the end of the period only the cash flow will be received. Very simple. Year now here in this case year 3 we have given now. What do you mean by that? At the end of year 3 you are going to receive 1 lakh. Same way here also, year 1 to 3. Okay, what it means? End of year 1, end of year 2, end of year 3, you are going to receive the same cash flow, 1 lakh, 1 lakh, 1 lakh. Are you understanding? This is something like EMI. Okay, you pay annual installments now, right? But what here we understand is that end of the period we assume we are paying or receiving, correct? Next, to come to perpetual cash flow. Right, we will, and the annuity level, we will also discuss the annuity immediate and annuity mid-annuity also. There I will explain it. Okay, present value factor, how to find for mid-annuity and annuity immediate and all, we are going to discuss. But generally, what do you mean by this one year 1 to 3 na? At the end of the year only you are going to receive the cash flow. Next, perpetual cash flow. Perpetual cash flow is nothing but, see, year 1 to infinity, which means from year 1 to infinity you are going to receive the same amount. There's something like dividend, perpetual dividend, assume a company is paying. Okay, we assume the going concern now, right? So 1 to infinity you are going to receive same amount of cash flow. Perpetual bonds are also there, like that. You can take example. This is perpetual cash flow, same amount of cash flow. It will continue till the infinity, right? Last type of cash flow is multiple uneven cash flow. What is this multiple uneven cash flow? Very simple. Every year different cash flows you are receiving. Year 1 you are receiving 1 lakh. At the end of year 2 you are receiving 4 lakhs. At the end of year 3 you are receiving 3 lakhs, which means every year It is not even cash flow like annuity we studied. Okay, this is uneven and this is multiple uneven cash flow, right? It is not only for 1 year. It is received for over the period of 3 years, but 3 or 4 years, any number of years. But the cash flows are different. Cash flow stream is also different. 1 lakh rupees you receive at the end of year 1, 4 lakh, 3 lakh, 5 lakh, any amount of this is called as multiple uneven cash flow, right? So what is the objective of this discussion is nothing but to calculate present value or future value of all these different types of cash flows. First you need to understand what is the relevance of this. We'll understand in fixed income securities, bond valuation, where we'll understand different types of bonds are available. Perpetual bond, annuity bond, okay, plain vanilla coupon bond, all these things we are going to study there. For that it will become a base for that discussion, correct? Say how to find present value of and future value of those. So we effectively came to know that there are two techniques, correct? One is discounting now bringing a future cash flows to present value terms, and there is compounding now taking today's cash flows to a future date. This is called as compounding. First we will discuss discounting, then we will move on to compounding. See, come to discounting, present value of single cash flow. How to find present value of single cash flow? See here, at the end of year 3 you are receiving cash flow of 1 lakh rupees, correct? First year end you received didn't receive anything. Second year end also you didn't receive anything. Third year end you receive 1 lakh rupees, correct? Now the interest rate is 10%. Assume interest rate is 10%. Discount rate is 10%. Not necessarily every time interest rate will be your discounting rate. I am just loosely speaking, interest rate is 10%. Discount rate is 10%. How to compute this? Very simple. Yeah. See here, present value factor for 10%. How will you compute? Very simple. See, everywhere you should use the same formula. You can see future value is equal to, or maturity value you have studied now, principal into 1 plus r raised to the power n. Here principal is nothing but present value, correct? 1 plus r raised to the power n. Future value is equal to present value into 1 plus r raised to the power n. Here future value is 1 lakh, present value is 1 lakh. Here future value is 1 lakh. Appo very simple. Future value is 1 lakh na. Appo present value, how much you need to deposit today so that after 3 years the value becomes 1 lakh. That is a question, correct? So very simple. Present value 1 plus, what is the r here? 10% na. I will put it 0.1, correct? 10% na 0.10. Then raised to the power n na 1 year is equal to 1 lakh. Appo what is present value is nothing but 1 lakh by 1 plus 0.1 or 1.1. Raised to the power 1 is same, 1.1 is equal to 75,130. Okay. Or you can just multiply this 1 lakh into present value factor. What is this present value factor? How to find the present value factor? There are three ways to find present value factor. Very simple formula. If you apply formula, you can get present value factor. How to apply formula? Na? 1 divided by 1 plus r raised to the power n will give you present value factor. If you want to find present value factor for 1 year, you replace n with 1. Say if you want to find a present value factor, in this case we want to find present value factor for 3 years, na? 1 divided by 1.1 raised to the power 3. Okay, it will give you present value factor for 3 years, 0.7513, right? Next, table method, very simple examination. Earlier they used to give the table. You can find it using table value. What you have to do now, the table, the 10% rate will be given on one side and the year number n will be given on the other side. You can take the value 10% 3 years now, you will get the value as 0.7513. Then you can use calculator. This is the easiest way to do, okay, or quickest way to solve these kind of questions, time value of money questions. How to do it now? Very simple. Here 1 divided by 1.1 you did not same. 1 divided by 1.1 you typed in the calculator. Okay, this is the calculator I use. For simplicity, this is a very good calculator. Casio 12-digit calculator you use. So what you do is that, okay, 1 divided by 1.1 you can do 1 divided by 1.1. Okay, then what you should do, press is equal to 3 times. Why you are pressing is equal to 3 times? Now, when you press again is equal to now, very simple, yeah. 1 divided by 1.1 into 1 divided by 1.1 into 1 divided by 1.1. 1.1. This is nothing but, okay, 1 divided by 1.1 raised to the power 3. This is as good as this one, correct? So you have to just press is equal to 3 times, you will get present value factor, that is 0.7513. This is how you will find present value factor for single cash flow. Okay, present value factor for single cash flow, and you will multiply it with 1 lakh and you will get discounted. Very simple, yeah. What is this 0.7513? I'll tell you. 1 rupee, see, this is year 1, 2, 3, correct? Now at the end of third year, you are going to receive rupees 1, correct? So rupees 1 received at the end of third year is as good as receiving 0.7513 today. I told you now, today's money is more valuable than tomorrow's money, which means today if you receive 0.7513, which means 75% of your 1 rupee. Okay, it is as good as receiving 1 rupee after 3 years. This is the understanding. Next, come to present value of annuity cash flow. Now we'll understand what is present value of annuity cash flow. Very simple, yeah. See here, this is annuity cash flow. Now, year 1 to 3, which means every year at the end of year 1, year 2, year 3, every year you are going to receive 1 lakh rupees. In that case, you tell me what is the value in today's terms of all these cash flows, which means it is not year 1 to 3 now. Every year you are going to receive 1 lakh. Okay, total 3 lakh rupees you are receiving. Okay, on varying dates. Now the year end of the year 1 you are receiving 1 lakh, end of year 2 you are receiving 1 lakh, year 3 you are receiving 1 lakh. Okay, is the value total? Can I just total add it up and say 3 lakh is the value? No. You have to bring it all these cash flow to present value terms. How to bring it? Very simple. You multiply using present value annuity factor in this case. See, here present value annuity factor is 2.4868, and if you apply it to 1 lakh rupees, you will get it. That is not an issue. How to compute this annuity factor is what we are going to learn. Very simple. There are 4 methods. Formula, you forget about formula. It is confusing and you will not be able to easily remember. Forget about it. Very simple. I'll tell you how to compute this. See, I'll get back to the table. Annuity table, you will find this. Okay, refer annuity table. If you take present value table is different, annuity table is different. If you take annuity table, okay, present value annuity table, there you will find this year 3 10%. If you see there, you will get this 2.486 is an annuity table, correct? But no one uses table these days, correct? So how to find it? Very simple. Calculator is the best method. What you should do? Very simple. 1 divided by 1.1 is equal to 3 times. You press na, correct? So in your calculator, if you press 1 divided by 1.1, why 1.1? It depends on what rate you are discounting. Say you need to discount at 15%. What you will do? 1 divided by 1.15 you will take, correct? The 1 plus r raised to the power n is there, na? The denominator rate, you should replace it with whatever rate you want to discount or compound it. Are you listening? Which means 5% if you want to discount. 1 divided by 1.05 I will put in the calculator. 1 divided by 1.05 I will put, and then 3 times I will press is equal to, then I will press GT. Then I will press grand total. I will get this annuity table. Okay, conceptually it is very simple. I will write it like this. Okay, see, at the end of year 1, year 2, year 3, all these years cash flow you will receive 1 lakh, 1 lakh, 1 lakh, correct? Now, very simple. Present value factor, we already know that this is, see, 1 divided by 1.1. Now, first year present value factor is 0.9091. Second year present value factor is 0.8265. Then third year present value factor is 0.7513. Total these present value factor alone, you will get it, correct? See, very simple. The total of this is 2.4868. This is nothing. Also, you can also calculate 1 lakh into 0.9091. Okay, 90,910 or something, and 82,650. Again, 75,130. You add it up, you will again get this 2,48,680. This is present value annuity factor. So annuity cash flows, how to bring it to present value terms, how to discount it and bring it to present value terms, which means, to put it simply, what I mean by this is, see, from today for next 3 years, at the end of year 1, year 2, year 3, I am going to receive 1 lakh, 1 lakh, 1 lakh. Even though I received 3 lakhs rupees over a period of 3 years, next 3 years, but the value of that in today's terms is only 2,48,680. Are you understanding this? This is the understanding for annuity factor. Next, we will move on. Okay, I'm briefly discussing. In the regular batch, we will discuss all this in detail, but not here. Okay, we will quickly move on. Say, present value of level perpetuity cash flow. What is this perpetual cash flow? Now, you already know that. Okay, 1 to infinity, which means year 1 to infinity, I am going to receive 1 lakh rupees. Assume there is a perpetual bond and paying interest at a rate of 10%, and I have deposited, say, 10 lakh rupees, and I am going to receive 1 lakh rupees forever. Correct? Now, what is the present value of this cash flow? Very simple. Perpetual cash flow, level perpetual cash flow. I am going to discuss about growing perpetual next. That is not an issue. Here we are going to discuss level perpetuity. Level perpetuity, the cash flow will not change. Okay, the cash flow which you are going to receive, the 1 lakh will not change. Every year you are going to receive 1 lakh, 1 lakh, 1 lakh only. This is called as level perpetuity. Are you understanding? What is this present value of this level perpetual cash flow? Is very simple. Okay, the present value of level perpetual cash flow is cash flow divided by R. Now, cash flow is how much? How much you are receiving every year? 1 lakh rupees divided by R, the rate of interest which at the rate which you used to discount it. Say it is 10%. In our case, it is 10%. For simplicity, we assume that 10% is the interest rate. Every year the bank, suppose you have deposited in the bank for 10 lakh, the bank deposited 10 lakh rupees, and every year they will pay interest at 10%, and forever they will pay and assume. Then what will happen? The 10 lakh rupees into 10% becomes your interest, na? So interest divided by the rate of interest will give you the amount to be deposited. That's a present value, correct? So very simple. 1 to annuity every year you are receiving. This is nothing but 10 lakh rupees. The discounted cash flow, the present value of this level perpetual cash flow is 1 lakh. What is the difference between level and growing? We have to discuss. See here, next, present value of growing perpetual cash flow. Why I am discussing this here? There is a reason. Okay, we are going to discuss the equity valuation chapter, dividend discount model, dividend growth model and all, where we are going to study various models. There it will be very useful, but the concept you need to understand here itself. Okay, the concept will not change. Listening, so here present value of growing perpetual cash flow, where the rate of growth, okay, the growth is stable forever. The growth rate is not changing, and the growth rate is forever same, which means, say, assume I am going to receive, how it will be now, I am going to receive year 1 to infinity, okay, but that amount is not same as what we learned previously. Previously we learned now 1 lakh rupees we will receive forever. The same 1 lakh rupees will be received forever. But in this case, what is happening? Every year that 1 lakh rupees will grow constantly at some given rate, say 5%, which means first year you receive, you deposit 1 lakh rupees, next year you will receive, say 1 lakh 5,000. Okay, next year again 5% interest. Like that you compound it every year. 5% is the growth rate. Understood? Okay, the cash flow itself is growing at a rate of 5%. How to find present value of this growing cash flow? Okay, formula is simple. I'll derive the formula also and show you. Why? Because the derivation is very important. Once you understand this, you will understand various things in equity valuation chapter. That's why I'm explaining here itself. It might take some time, but still I'm explaining here itself. See, the formula is very simple. There is a mistake. Cash flow 1 pi. What is this happening now? See, you are going to receive for year 1 0 cash flow 1. Okay, the cash flow, what do you mean by cash flow 1? The cash flow which you receive at the end of year 1. Cash flow 2, the cash flow which you are going to receive at the end of year 2. Like this, cash flow 3, cash flow 4 and so on. Correct? So, how to find this present value of all these cash flows? Cash flow 1 to, cash flow 1 to, cash flow 1 to, cash flow infinity. Okay, present value of cash flow 1 to cash flow infinity you need to find. Correct? The formula is very simple. Present value is equal to cash flow 1. That is first year cash flow. That means first year cash flow divided by the rate at which you are compounding. Okay, rate at which you are discounting. We are discussing discounting. So the rate at which you are discounting, or interest rate you can say. In equity valuation chapter, this R becomes your KE. We are going to study later. No issues. This R minus the growth rate. G is what? Growth rate. This is formula for finding the formula for present value of the growing cash flow. Growing cash flow, perpetual cash flow, and the growth rate where is stable. Okay, the growth rate is also stable. So how to derive this formula? What is the derivation of this formula also we are discussing. Okay, see, very simple. Present value of cash flow 1 to cash flow infinity. So what is that? Very simple. First year you are going to receive cash flow 1. Correct? How to discount it? 1 divided by 1 plus r raised to the power n. First year 1 plus r raised to the power 1. Correct? 1 plus r raised to the power 1. So present value of this is present value of first year cash flow. Agreed? Year 1 cash flow. If you discount and bring it to present value term, how to find it? Cash flow 1 divided by 1 plus r raised to the power 1. Next, year 2 cash flow is there. What you will do? Cash flow 2 divided by 1 plus r raised to the power 2. Correct? We already discount 2 year discount. Present value annuity factor. Yeah, present value factor for second year. What you will do? Cash flow 2 discounted by present value factor of second year. 1 divided by cash flow 2 into 1 by 1 plus r raised to the power 2 is as good as cash flow 2 divided by 1 plus r raised to the power 2. Next, year 3 you have cash flow 3. Correct? Third year cash flow you will discount using third year present value factor. What is that? 1 plus r raised to the power 3 and so on and so forth. Correct? This will continue till perpetuity. I am not going till perpetuity. Understood this? Now see here. Now if you see this cash flow 2 and cash flow 3 are there. What is that? First year cash flow is cash flow 1. Correct? Now this is 1 plus r raised to the power n. That is there is no doubt about it. Plus cash flow 2 is nothing but, I can also say that cash flow 2 is nothing but cash flow 1 into 1 plus g. Correct? Why? Every year it is uniformly growing at a constantly growing at a given rate. Okay, for example, if you assume it a 5 percentage as growth rate, what you will do? Cash flow 1, cash flow 2 is nothing but cash flow 1 into 1 plus growth rate 0.05. Correct? Up 1.05 cash flow 1 into 1.05 will give you cash flow 2. Correct? Denominator will be same, 1 plus r raised to the power 2 plus cash flow 3 is there. Again, what is cash flow 3? Cash flow 1 into 1 plus g the whole square divided by 1 plus r the whole square. Agreed? Are you all listening? This I can collectively write now. So what it means, again, if you notice, from there is a geometrical progression going on. Like this I can summarize. Correct? So we can see that this forms an infinite geometrical progression. Okay, so geometrical progression, summation of the infinite. We need to find summation of all these, cash flow 1 to cash flow infinity, present value of cash flow 1 to cash flow infinity. If you want to find the present value, it is obviously these are all forming geometric progression. Okay, summation of all these geometrical progression. Okay, there is a formula, A divided by 1 minus R. You would have already studied in your basic 12th maths and foundation, correct? So this is A by 1 minus R. Now, A is nothing but the first input of the progression, correct? That is cash flow 1. Assume cash flow 1 is the first input. Then see 1 minus R. What do you mean by 1 minus R? Very simple. Inge R means the rate at which it is growing, correct? 1 minus R na, at what rate? The rate of the progression is denoted by R. Okay. How to find the rate of progression? Very simple. You see, this is first term, cash flow 1 by 1 plus R divided by cash flow 1 plus G by 1 plus R raised to the power 2 plus cash flow 1 plus G the whole square divided by 1 plus R cube, correct? Like this it goes on. Either. Now here, if you divide the second by the first value and divide the third value by second value, you will get the same value because geometry progression, same rate it is keep on growing, right? So to find the rate of progression, what you will do? Very simple. Cash flow 1 plus G, which is nothing but cash flow 2 divided by 1 plus R to the power 2, this term, correct? Into what you should do ideally, you should divide it. Divide it by cash flow 1 by 1 plus R you will do, or you can multiply if this goes upwards into 1 plus R divided by cash flow 1. This is cash flow 1. So what you will get, this R plus R, 1 plus R will get cancelled and you will get R as 1 plus G divided by 1 plus R. Very simple. If you carefully observe, the 1 plus G is keep on getting added in the numerator. Like this in the denominator, 1 plus R is keep on getting multiplied. Are you all understanding? So progression is nothing but here 1 plus G divided by 1 plus R. If we apply to this, see 1 minus G, see here cash flow 1 divided by 1 plus R is our numerator, that is A, correct? And if we divide it using this 1 minus the rate of progression we found out 1 plus G divided by 1 plus R is nothing but 1 minus 1 plus G by 1 plus R. Okay, if we solve this, see cash flow 1 divided by 1 plus R, then if you multiply this, what will happen? Very simple. Minus 1 plus 1 get cancelled. R minus G will be there. Very simple. See here. Here 1 minus 1 plus G 1 is 1. See here. 1 into 1 plus R minus 1 minus G minus 1 gets cancelled. R minus G divided by 1 plus R will be the denominator. If you bring it to numerator, if you multiply it, what will happen? Okay, in the numerator, you will get 1 plus R divided by R minus G, wherein 1 plus R and 1 plus R will get cancelled. You will get ultimately cash flow 1 divided by R minus G. Are you all understanding? This is the derivation for the first formula we discussed now. See, the formula is simple. I have given the formula. Cash flow 1 divided by R minus G is the formula to find out present value of the perpetual growing cash flow, wherein the growth rate is stable. Okay, one caveat is there, the growth rate is stable. If the growth rate changes, for example, for first 5 years, one growth rate, second 5 years, one rate, we are going to study in the 3-step dividend model, 2-step dividend model and all, where we study that if growth rate changes, you cannot apply specific formula. We have to go specifically for each block by block, you have to compute and then find out the present value, correct? So this is the derivation for this, understood? Where this is useful, I'll let you know later. Okay, equity valuation chapter, I already told you, there it is useful. And at that time, you need to understand the G will be same, growth rate will be given. Okay, the growth of the earnings will be given, that is not an issue. The R is to be understood as KE, there it will be KE. Required rate of return of equity holders, right? Next, see here, summary I have given here, present value of perpetual cash flow, level perpetual is there, constant growing perpetual is there. Level perpetual cash flow divided by R will give you the present value, and for a growing perpetual cash flow is nothing but first year cash flow or cash flow 1 divided by R minus G. This only, the cash flow becomes dividend discount model, the cash flow becomes D1 by KE minus G. Have you all heard about this formula? The derivation of both these formulas are same. Are you listening? The R gets replaced with KE and the cash flow, first year cash flow gets replaced by D1. Why? Because dividend discount model, the cash flow arising from holding equity shares is nothing but dividend. So D1 by KE, all these things I have given. Okay, you can simply go through. Next, present value of multiple uneven cash flow. Very simple. See, every year I am getting different amount. Multiple uneven cash flow means what? At the end of year 1 I am receiving some cash flow 1 lakh rupees, end of year 2 I am receiving 4 lakh rupees, year 3 I am receiving 3 lakh rupees, which means my cash flow is uniform or not uniform or not uniform. Correct? Every year I am receiving different cash flows. How to find present value? In this case, you have no choice. What you have to do is that you have to present a table like this. You have to put a schedule and you have to find discounting factor. You have to find present value factor for each year. Then you multiply with cash flow of the respective year. Are you listening? So present value factor at 10% for 1 year period is 0.9091. 2 year period at 10% is 0.8264 and 3 year period is 0.7513. You multiply it with respective cash flow and arrive at discounted cash flow for each year. Okay, for each year's cash flow, you will get discounted value, discounted cash flow. And what you do? You add all the present values and you will get the total present value of all these future cash flows. Are you listening? Which means very simple. 1 lakh rupees received at the end of year 1 plus 4 lakh rupees received at the end of year 2 plus 3 lakh rupees received at the end of year 3 is as good as receiving 6,46,860 receiving today itself. It is as good as receiving this much amount, 6,46,860 receiving today. This is the understanding. Are you understanding? Are we clear with this? Shall I proceed? Okay, I'm quickly discussing because I can't keep on dragging this, so I'm quickly trying to discuss. Next is present value of annuity immediate. I told you already that we have covered all these cash flows, but annuity cash flow, I told you there is one more thing to cover, which is if question there is nothing given now, we always assume that we are receiving the cash flow at the end of year 3. In FR also, in the leasing questions, India is 116. You remember leasing question also, if nothing given in the question, we assume that it is received or paid at the end of year. Okay, year 1 or year 2, anything. Okay, unless the question specifically gives that it is paid, the first installment is paid at the beginning of the year. And adjustment, like that, they will give us adjustment. Correct? Only in that case we assume. Like that here also. See, sometimes what happens, insurance contracts, insurance premium you paid. Correct? You pay insurance, if you take insurance, you pay premium for that. Usually what happens, generally insurance premium all paid at the beginning of the year, not at the end of the year. Premium, first they will take the premium initially. Correct? So in that case, it is also annuity. Every year the premium will be same. Assume, okay, there are so many schemes, but assume the premium is same, but you will pay at the beginning of the period. Understanding? So the insurance company will receive the premium at the end of the period, beginning of the period. Now, say assume year 0, today you are receiving when you are entering into contract, when you start your insurance, you will receive, the company receives the premium first day itself. Correct? Year 0. At the end of year 1, it will receive some amount. End of year 2, it will receive some amount. Correct? 3 installments it receives. But the value is same or different? Different. Why? Because at the end of year, you will bring it to present value terms. Year 0 you need to bring. Correct? So in that case, first year cash flow, first installment which you are receiving, the present value factor is 1, which means that there is no discounting needs to be done. The money value will be same. It's very simple. Today I am receiving 1 lakh rupees. What is the present value of this 1 lakh? 1 lakh only. Why? Because this is received today itself. There is no inflation involved. There is no risk involved. So that you don't need to compensate for risk, inflation or risk at all. There is certain amount. So there is no risk involved. So there is no need to discount. Which means the present value factor will become 1. So present value of the annuity cash flow which you are receiving at the year end annuity, that will have different value, and year beginning annuities, it will have different value. Correct? Now we are going to study how it is computed. Very simple. See here. When annuity occurs at the beginning of every period, it is referred to as annuity immediate. Annuity discussed earlier occurs at the end of every period, is also called as annuity due. Now we are going to discuss, see here, annuity cash flow, normal or due, end of the period. What we will do? Year 1 to 3, which means at the end of year 1, end of year 2, year 3, you are going to receive 1 lakh. For that, how to discount, bring it to present value factor? Use the annuity factor, 2.4868, some number you got, that you multiply and find it out. Correct? Now what we are going to discuss, that annuity cash flow, immediate cash flow, which means year 0 to 2, which means year 0, now itself you will receive 1 installment. Okay, 1 installment is over. Next there are 2 installments. When you will receive at the end of year 1, because at the end of year 1, whatever amount you are receiving, it is as good as you are receiving it at the beginning of year 2. Correct? And end of year 2, it is same as beginning of year 3. Understood? This is called as annuity immediate. In this case, what happens? Year 1, year 0, whatever you are receiving as first installment, that is certain. Annuity factor for that is 1. Correct? Next year 1 end you are receiving some amount, and second year end you are receiving some amount. For that you need to find discounting present value factor, and you will add 1 to these 2 factors. Listening, I will show you very simple. In this case, year 0 to 2 you are receiving 1 lakh. Abdina, I will show you what is happening. Year cash flow. Year 0, which means today itself, at the beginning of year 1 you are receiving 1 lakh. 1 lakh. At the end of year 1 or beginning of year 2. Understand? It is as good as beginning of year 2, you are receiving again 1 lakh rupees. Then end of year 1, end of year 2 or beginning of year 3, end of year 2 or beginning of year 3, you are receiving again 1 lakh rupees. Correct? Now all these cash flow you need to see here, present value terms. Year 0, now itself you are receiving 1 lakh. Now the present value is 1. Present value factor is 1, which means the value is same as whatever you receive today. Appa 1 lakh rupees received today is as value as 1 lakh rupees. Present value is nothing but 1 lakh rupees. And the first year end which you are receiving 1 lakh, for this the present value factor is 0.9091. Already computed, we computed, correct? So 1 lakh into and then the third year which you are receiving, what you will do, 1 divided by 1.1 is equal to 2 times you press. It is as good as year 2, second year end you are receiving. So it is present value factor for year 2, 0.826. Now you total all this, you will get annuity factor for annuity immediate. Present value annuity factor for annuity immediate transaction for 3 years period, wherein first installment is paid at the beginning of the period. So 1 plus 0.9091 plus 0.826, that is 2.735. Okay, this is the number you will get. Very simple. Here you can see year 0 to 1 lakh. How to find this annuity factor 2.7355? Very simple. What you do is that you have 3 years installment. Other first cash flow, the annuity factor is 1. So next 2 years you take annuity factor as we do that. Instead of 3, you just cumulative collect 2. Correct? You take 1 divided by 1.1 is equal to press 2 times in the calculator. Press GT, you will get 1.7355. Then add 1 to it, you will get 2.3755. See, calculate annuity factor for n-1 annuities, which means 3 annuities. Okay, we discussed there n-1 are 2 annuities you use using the present method. Then add 1 to it. For example, in the above case, there are 3 annuities. Hence, calculate annuity factor for 2 annuities, you will get this much and add 1 to it. So 2.7355, which means, what is the interpretation here? Very simple. Year 0 to 2, cash flow is 1 lakh. And the value is 2,73,550. What do you mean by that? Okay, if you are receiving 1 lakh rupees 3 times, that is, initially at the beginning of year 0 you are receiving, beginning of year 1 you are receiving, which means today you are receiving 1 lakh. After one year you are receiving 1 lakh. After 2 years you are receiving 1 lakh. It is as good as receiving 2,73,550 today itself. The value of 3 lakhs, actually if you total, it will come to 3 lakhs, correct? The value today, if you receive everything, it is as good as receiving 2,73,550. This is the understanding. Next, present value of mid-annuity. There is another thing, that is mid-annuity. How to find present value of mid-annuity? What do you mean by mid-annuity? You need to understand. Very simple, yeah. Take this example, you will get absolute clarity. Exactly 10 years from now, Srichand will start receiving a pension of 3,000 rupees a year. Very simple. Pension, assume you are 40 years age, you are going to receive pension, uniform pension after 60 years, which means after 20 years for a period of some number of years, 20 years assume you are going to receive, which means today is you are 40 years of age, and then your pension is going to start from 60 years, not from today. After 20 years it is going to start, and it is going to be paid for a period of another 20 years, which means overall time frame is 40 years, out of which first 20 years you will receive nothing. After 20 years you will start receiving every year 3,000, some amount here. Okay, for example, in this case what is happening? Very simple. See, in this case what is happening? The payment will continue for 16 years, but exactly 10 years from now, which means not from today. What it really means, first 10 years you will receive nothing. After 10 years he is going to get retired. Thereafter, for next 16 years, he is going to receive 3,000 rupees every year. 3,000 rupees every year. So this is annuity only. Annuity, same amount of cash if you receive for prolonged period. Okay, then it is called as annuity. Now, whether your annuity is going to start today? No, only after 10 years period, and it will stay for 16 long years. Correct? So which means total period is 26 years, out of which first 10 years you are not going to receive anything. After 10 years, for a period of 16 years, you are going to uniformly receive 3,000. How to find present value factor of this? Today you want to find the value, not at the end of year 10. Today, in year 0, you want to find this cash flow, which is you going to. Have you all seen this LIC? Okay, schemes and all? If you notice, the pension plan will be there. Okay, Jan'26, Jagannathan, pension plans are there, and there they will tell the deferment period will be given, which means if you deposit some, say 50 lakh rupees or 10 lakh rupees, some amount you deposit. Okay, they will ask for deferment period. After 5 years, only your annual pension will start. They will pay annual pension of some amount here. Okay, as per the scheme, they will pay, which means for the first 5 years, they will not pay you anything. Then after 5 years, for a period of some given number of period or till the life, they will pay the pension of some fixed amount. Correct? So this is something, pension scheme and all are like this. So how to find present value of these? Very simple. What you do, in this case, you want to find the cash flow is occurring between 11th and 26th year, and you want to bring it to year 0. What you will do? Very simple. Find the present value annuity factor for 26 years for longer period. 26 years annuity factor you find out. Very simple. Yeah, annuity factor at 10% for 26 years you find it out. Very simple. How to find it? Take your calculator. 10%. So 1 divided by 1.1 you will do. is equal to 26 times you press, and then grand total you press, GT you will press, and you will get 9.1609 as number. From that, you reduce what the first 10 years is not relevant now. Okay, no cash flow occurs in the first 10 years period. So what you will do, you will reduce the annuity factor for the first 10 years. How to do that? Very simple. First you need to find 10 years annuity factor. Now, 1 divided by 1.1, because here 10% discount rate is given. 1 divided by 1.1 is equal to 10 times you press, grand total you press. This is the annuity factor for first 10 years, 6.1446. You reduce from this 9.1609, okay, 26 years annuity factor you find, minus first 10 years annuity factor you remove from it. Balance is the annuity factor for 11th year to 26th year. Are you understanding? This is called as mid-annuity factor, that is 3.0163. Okay, if you use this annuity factor and multiply with the annuity given 3000, you will get 9,049 rupees. What the understanding is now? Very simple. The value of the cash which you are going to receive, okay, from year 11 to year 26 in today's terms is 9,049. Are you understanding? Even though the 3,000 rupees, very simple, yeah, this 3,000 rupees you are getting for say 11 to 26, now 15 years, correct? 3,000 into 15, if you see, it is 45,000. Collectively it is 45,000. This 45,000 is received over a period of next from 11th to 26 years. Now, in today's terms, if you see, the value is only 9,000 rupees, which means even though I am receiving the cash flow from year 11 to year 26, the value of it in today's terms is only 9,040. It's as good as 9,049, which means today if someone is paying 9,049, it is as good as, okay, either you can pay today 9,049, or you can defer this payment for 10 years, and after from 11th year, you can pay me 3,000 every year till year 26. The value will be same. 9,049 is the value. Are you all understanding? Set. This is all about mid-annuity factor. Now we'll move on to quickly discuss compounding. What is compounding? Very simple. Putting interest to your principal is called as compounding. Taking out interest is discounting. Correct? Discounting, taking out the compensation for inflation and risk and removing these and bring the cash flow to present value terms is known as discounting. Now we will discuss that. We already discussed. Now we are going to discuss how to add the interest and take the present value to the future value. Are you all listening? Okay, this is called as compounding. Now very simple. First, single cash flow, how compounding happens. First we will start with single cash flow. See, very simple. 1 lakh rupees you are going to you deposit in the bank 1 lakh rupees, correct? At a fixed interest rate of 12% for 5 years, which means every year I'm not going to receive interest. Have you all seen the bank FD and all? If you see, while you deposit itself, they will give you the maturity value. What you are going to receive after 5 years, they will give you. How? They will compute already the compounding, they will consider, and then they will compute and give you, correct? How to compute is only we are discussing. Very simple. See here, present value, future value, same formula. Future value is equal to present value 1 plus r raised to the power n. Compound interest formula, yeah. Maturity value is equal to principal into 1 plus r raised to the power n. Have you all studied this? Same thing, yeah. Here, maturity value, here 1 lakh is deposited today, na. Up present value, future value is equal to 1 lakh rupees into 1 plus 0.12, 12% interest rate in this case, raised to the power 5 will give you this present value, future value factor. This is also called, this 1 plus r raised to the power n is also called as future value factor. Are you all listening? This we got as a 1.76234 in this case. At 12% for period of 5 years, we get 1.76234. Very simple, yeah. This is nothing but, see, compounding is very simple. 12% interest rate. Now take your calculator. Okay, you can use your calculator. 5 years, 12%. How to compound? 1 lakh rupees. You can also compound like this. See, 1 lakh rupees into 1.12. This is at the end of year 1. The maturity value will be 1,12,000 into again you will get interest for interest also. This is what is compounding effectively, right? So what you will do is that 1,12,000 into 1.12. Like this, you press 5 times. How much you will get? Okay, you will get into 1.12, 1,76,234. Are you listening? 1 lakh into 1.12 into 1.12 into 1.12. Like this, if you do every year, 12% is getting compounded, but on an enhanced base. See, 1 lakh, if you apply every year 12%, you won't get 1,76,234. This is effectively the compounding. Are you listening? Okay, 1 lakh at 12% if you compound, next year it will become 1,12,000. On that amount, you again compound. This is the effect of compounding. Listening? So next, annuity cash flow. Very simple. Mr. S is deposits 1 lakh rupees today, and it carries interest rate of 12% for 5 years. What is the maturity value? Every year he deposits 1 lakh. Unlike in the previous question, okay, that person deposited 1 lakh initially, and then after 5 years, in the intermediate period, he never deposited anything. Are you listening? In the present case, annuity cash flow, right? Every year he deposit 1 lakh. That is why it is given as RD account. RD account you need to do na. Okay, recurring deposit. Every year you deposit something, and that gets compounded. Listening? So very simple. 1 lakh rupees is the cash flow. What is the compounded cash flow? How to compute compounded cash flow? Cash flow into future value annuity factor, or future value factor. How to find future value annuity factor? How to find future value annuity factor? Very simple here. What happens effectively here? See, I'll put it like this. Here 1, 2, 3, 4, 5. What happens is, okay, deposit. He is depositing some amount. Now this is cash flow. How much is that? 1 lakh. He is depositing. Next year also 1 lakh. Same way he is depositing every year. 1 lakh. Na. Now what happens is this. You need to take it to future value. This 1 lakh on the end of year 1. You need to take it to 5th year. Second also you need to take it 5th year. Third also compounding na. Correct? You add interest and take it to future date. Today's cash flow, you take it to future days, known as compounding. Next, so how to do it? Very simple. This is at the end of year. Wherever I told you, wherever there's nothing given, you should assume you are receiving the amount or paying the amount at the end of the period. So end of year 1, you are receiving 1 lakh rupees. Assume you are depositing 1 lakh rupees, which means for how many years interest will be paid? For 4 years, because 1 year elapsed already. So remaining 4 years period is there. 4 years interest will be paid, which means 1 lakh into 1 plus R, here 12%, 1.12 raised to the power 4. Correct? This 1 lakh, okay, with interest will become 1 lakh into 1.12 raised to the power 3. In a second year end, after 2 years, you can only deposit for 3 years. Agreed? So next, third year cash flow is 1 lakh into 1.12 raised to the power 2. Because cash flow received at the end of year 3, you can deposit for 2 more years. Next, 1 lakh rupees, again, what you will do, you will deposit for 1 year only. Correct? Last year, okay, you cannot deposit at the end of year 5 you are receiving. The present value, the factor will be 1, which means that ideally it is as good as receiving 1 lakh is the value. Future value is also 1 lakh. Right? So what you will do is that effectively you add all this. This alone, if you add, also you will get the future value factor. Correct? That is given as and future value annuity factor, that is 6.3528. Either you can do that or you can simply calculate like what I told you. Okay, how to find it? See, 1 lakh into 1.12 raised to the power 4 plus 1 lakh into 1.12 raised to the power 3. Like this, if you get, add, you will get here. See, in this case, each year deposits 1 lakh rupees. Correct? So cash flow is 1 lakh. Printing mistake is there. 1 lakh into 6 lakhs 35,280. Printing mistake is there. No issue. 6 lakhs 35,280. What do you mean by that? Every year I am depositing 1 lakh rupees. Ideally, the total is, see, generally the total is 5 lakh rupees. Total principal amount deposited is 5 lakh. And the interest portion is 6 lakhs 35,280 minus 5 lakhs, 1 lakh 35,280. But this interest is received over a period of 5 years. Okay, for a different principal portion. Are you listening? This is not interest received for same amount, different amount. Collectively, the interest is 1 lakh 35,280. This is how you will find future value of this 1 lakh annuity amount deposited every year for a period of 5 years, given that interest rate is 12% per annum. How to compute it, I showed you. And one more formula also you can use for finding future value annuity factor. I'll tell you, future value annuity factor is equal to present value annuity factor divided by present value factor. This is very simple. Okay, in intermediate, if you have the older syllabus, there was time value of money. There, this formula would have been given. Okay, very simple. Yeah, present in this case 12%. 12%. 5 years is the given period. Correct? So first to find present value annuity factor. How to find present value annuity factor? That we already know. 1 divided by 1.12 we will do, because 12% interest rate, right? Is equal to 5 times. Press GT, we will get 3.6047 divided by 1 divided by 1.2, 1, 2, 3, 4, 5. Present value factor for the 5th year. How much you will get? 0.5674. Please divide it, 3.6047 divided by 0.5674, we will get 6.353. Okay, it's a rounding off issue, but as good as 6.3528. Numbers are almost same, the rounding off. But you can also calculate using this formula. Present value annuity factor divided by present value factor will give you future value annuity factor. You have to understanding the difference between all these. Understood? Next. See, I've given you notes, you can go through. Okay, the entire thing is given as PDF in our website, free resources. If you go there, chapter by chapter, I have uploaded the PDF. Understood? Say, next is future value. Here is the formula. You can use this future value factor table also. You can use annuity factor formula. You can use this, or annuity factor formula itself. This you can use, or present value annuity factor divided by present value factor. If you feel this is complex, this will be very easy, right? Say, next we'll come to continuous compounding. Okay, before understanding continuous compounding, I'm going to discuss that continuous compounding, where it is useful. Now, in derivative segment, when we value derivatives, okay, in the entire derivative segment, we use continuous compounding. E to the power TR, everything will be continuously compounded or discounted. Continuous discounting or continuous compounding we use. We never use normal compounding like what we use here, correct? So for that, you need to understand how this actually works. Okay, we need to use the calculator. Even though in the examination nowadays, the E value will be given in the question itself, but still we need to know, if at all they have not given, now you need to be very comfortable with calculating using calculator. That is also, so we will learn how to, we'll understand how to find this continuous compounding. See, first for that, before discussing continuous compounding, first you need to understand for varying time periods how compounding works. For example, compounding non-annual, till now we discussed annual compounding, correct? Year wise they have given at the end of 5th year, 3rd year, yearly they are compounding, we have done. Now we need to understand how so non-annual compounding happens. See, very simple. See this example, through this example we'll understand everything. Kubera deposited 1 lakh rupees in a fixed deposit carrying interest rate of 12% 5 years. Same 12% 5 years only, and deposit 1 lakh rupees. Okay, one time 1 lakh rupees is deposited. Now maturity value we need to find at the end of year 5, but the catch is first annually. We already computed annually how to find it. 1 plus r raised to the power n. Future value is equal to present value into 1 plus r raised to the power n. This we already computed, no need to go there. Next, semi-annually we need to compute. When they ask about semi-annual, what do you do? You need to convert the given data into periods, which means very simple. 12% is the interest rate. Okay, this is interest rate 12% per annum, correct? Now they have asked semi-annually, 6 months period. So semi-annually the interest rate is 12% per annum. You need to convert this data into semi-annual, which means 6% compounded semi-annually. Compounded semi-annually. Semi-annually. Okay. Then there is one more data, 5 years. 5 years, n is equal to 5 years they have given in the question. Now you need to convert semi-annual period. In the 5 years, how many semi-annual periods are there? 10 semi-annual periods are there. Semi-annual periods are there, which means n will be taken as 10. Are you all understanding? R will be taken as 6, n will be taken as 10, and the amount is same, 1 lakh rupee you will take, and then you will compound. You will get the answer. Very simple. Yeah. See here, half yearly compound. There's nothing new. You already know. I think 1 lakh rupees here. 1.06. Why 6? We converted into 6%. Correct? 1.06 you take raised to the power 10. Why? 10 periods are there in the 5 years. How many semi-annual periods are there? 10 semi-annual periods. So we'll convert this data into semi-annual period, and this is the future value factor for these many periods, and we will find 1,79,080. Now quarterly compounding is same. Quarterly, one quarter, how many months are there? 4 months or 3 months? Okay, 3 months, correct? Up we'll convert everything into 12% interest. 3 months period we need to convert now, divided by 4. How much we'll get? 3%, correct? Same way. N is given. What is that? 10 is given. Actually, how many 3 months? 4 years, 20. Actually, here 20 should be there, right? So 1.03 raised to the power 20, you will get 1,80,610. Are you understanding? Monthly compounding, here how many months are there for 5 years period? 60 months are there, and 0.01, 1% per annum, 12% per annum. How much interest rate per month? 1%, correct? Substitute the data, you will get these many numbers. Now all these are discounted for varying periods, annually, semi-annually, and monthly also. Like this, okay, in derivative segment, we use continuous compounding. We continuously compound the amount. Okay, in the futures pricing, option valuation models and all, risk neutralization model, everywhere you use, okay, continuous compounding or discounting. Right? Dividend also we studied there also. When you discount spot rate, revise the spot rate, compute revised spot rate, you need to remove the present value of the dividend. How to discount the dividend and remove it from spot price? Okay, you use continuous discounting. Right? So all this you need to understand how to continuously compounding or discounting. E to the power TR is there. Correct? How it works, how actually the formula is derived, how you can find it using calculator. This you need to understand, and then we will close the session of time value of money. See, last segment, carefully observe. See, future value is equal to, as per the continuous compounding, what we will do, the formula will get, so future value is equal to present value into 1 plus r raised to the power n we used to do here, PV into e to the power TR we will do. Understood? Very simple. Inge, these numbers should be annually considered. Very simple. Now you see, 1 year, 12%, 1 year is the time period, and 12% interest rate, correct? And you need to find the future value when this 1 lakh rupees is compounded continuously at 12% for 1 year period. Understood? In this case, how you will do? Very simple. E to the power TR. See, present value is simple. 1 lakh it is given. Into E to the power TR you need to find. How will you find? E to the power T. What is the time? What is the time? See, yearly time period only you need to take. Upper 1 I will take as such. There will be no change. Into 12% is there na? Into 0.12 I will do. Understood what I am trying to do? Okay, so 1 into 0.12 is as good as 0.12. Upper E to the power 0.12 you need to find. Understood? First you need to find E to the power 0.12. Then you multiply it with 1 lakh. You will get the value, future value of this 1 lakh rupees compounded continuously. How to find E to the power 0.12 is a subject matter of discussion. How to find E value of any number, okay, is a subject matter of discussion. Very simple. How to find E to the power value in any number? Na? E to the power x, here I have given it. Can you see this? Very simple. E to the power x, any number, is equal to 1 plus x raised to the 1, x power 1 divided by 1 factorial plus x power 2 by 2 factorial plus x power 3 by 3 factorial. Like this, keep on going. Are you listening? So what we do is that using calculator, you can either go till 3, or if you stop by 2 power is also sufficient. But we'll understand how to calculate. See, if you are calculating from third place, okay, if you are going till third place, you need to calculate from 3, 2 and 1. Very simple. We will do this here. E to the power 0.12. Na? I'm using the calculator and showing you, right? Very simple. First you write down 1 plus 0.12 is the number, correct? Raised to the power 1 by 1. 1 factorial is 1, right? Raised to power 1 also, anything raised to power 1 is also same number. Plus 0.12 raised to the power 2 divided by 2 factorial. 2 factorial is nothing but 2. 2 into 1, na? So 2, right? Plus 0.12 raised to the power 3 by 3 factorial. 3 factorial is what? 6. 3 into 2 into 1, which means 6. Right here, what we will do is that, assume we are going up to third term. Okay, we are going to till this number. How to compute? Very simple. Take your calculator, type 0.12 here, and you can use into is equal to. You will get 0.0144, correct? Again, what you do? Again, press 1 is equal to, which means into is equal to na, it is raised to the power 2. Agreed? Then again you press is equal to, it will be raised to the power 3. Now you will get some number. Then divided by 6 you will do. Some number you are getting. Now what you will do? Use the memory plus function. That is why I like these kind of calculators. Okay. Press the memory plus here. Then what you do? 0.12 raised to the power 2 na. Again press 0.12 into is equal to, you get 0.0144 divided by 2. Some number you are getting. Again put memory plus, right? Then what you do? Simply the 1, there's no value. So 1 plus 0.12 is there. Simply 1.12 you add it to memory plus and memory recall. You will get 1.12748 or some number here. This is the E power value, E power T. E to the power 0.12 value is nothing but 1.127. If you multiply this 1 lakh, you will get this 1,12,748. Are you clear with this? This is compounding. Discounting, nothing but very simple. Yeah, if you discount it, you will get, what is the discount? This is compounding. Discounting, how to discount? E to, see, present value into E to the power minus TR. E to the power minus TR is as good as, is equal to 1 by E to the power TR. Understanding? So 1 lakh into 1 by E to the power TR is as good as 1 lakh into E power minus TR. Both are same. In this case, what will happen? Very simple. Yeah, E to the power TR, you know this one, 1.12748. If you do 1 divided by 1.12748, understanding? How much you will get? 1 divided by 1.12748. You are getting 0.8869. Correct? This you multiply with 1 lakh into 1 lakh, you will get 88,693. This is present value of, if 1 lakh is to be received tomorrow, next year, if you discount continuously, okay, you will get 88,693. If you compound the today's 1 lakh value to next year value, you will get 1,12,748. Are you listening? This is how you will compute this is how you will compute compounding and discounting using continuous compounding method. Next, if the compounding period, that is for 3 years. 3 years if you want to compound, what you will do? E to the power TR we did. Other time is there. That T you substitute as 3. Always I told you the time will be taken as 3 yearly terms. So 3 will be taken into 0.12 and you will get the future value same way. If it is for 3 months, that is also possible. This is only mostly possible because if you see the options and futures contract are for 3 months period, 6 months period in Marla. We are going to learn throughout the derivative segment wherein 1 full year will not be there, but continuous compounding will be used. In that case, this is the most important topic. How to analyze this 3 months? How many years? In yearly terms, if you put it, how to get it? It will be as good as 0.04 years. Understood? 0.04 years, 3 months is nothing but 0.04 years. Correct? Up 0.04 into 0.12. Okay, how much you will get? 0.04 into 0.12. 0.0048. Up e to the power 0.0048 if you do, okay, you will get this number 1,03,445. Okay, and in our subject, rate of return predominantly means IRR. Wherever I am using rate of return. Why I am telling you this in time value of money? Later when we are going to discuss bond valuation and all, there we will use rate of return. Predominantly we will use the rate of return simply means IRR. We are going to study in equity valuation chapter and all. Predominantly rate of return in our subject means IRR. How IRR will be computed and all bond cash flows, we are going to anyway see in the YTM segment. Okay, interpolation method, how to arrive at IRR. Also intermediate syllabus, also capital budgeting chapter you would have studied. So I'm not going to discuss these details here, right? So with this, I'm closing this chapter, that is time value of money. Very, very important discussion. Why this is important? Because in various other places, wherever the discussion comes now, I'll only say I have discussed already in time value of money. I'm not going to discuss it again and waste the time there. Correct? We are trying to cover as much as possible with given we have limitation of the time now. So within 35, 40 hours, we have to complete entire syllabus. That is what our aim is. So I'm not discussing all this here. So wherever we need to discuss now, I'll tell you in the time value of money I have discussed, you go through that. So it is very essential to understand this chapter properly, okay, which will form part of the, which will form as a base for the subject to come, okay. So we'll continue discussing the fixed income securities in the next segment, okay. Thank you.